Welcome back. We just heard from Hank Paulson. 10 years after the financial crisis, my next guest is predicting a recession for the first time in 10 years. The U.S. economy, meanwhile, is running on all cylinders right now. But with the midterm elections just ahead and a rising rate environment, are there hazards on the horizon? Joining me right now to discuss this and a lot more is economist Nouriel Roubini. Roubini, called by Foreign Policy magazine one of the top 100 global thinkers, thinks another recession could be coming. He was one of the few who predicted the 2007-8 housing collapse. And Dr. Roubini, it's always a pleasure to see you. Thanks so much for joining us.
Great being with you.
Thank you so much, Nouriel. You have concerns about where we are on the horizon. But first, characterize where we are right now in terms of the economy.
Well, the economy, both U.S. and global, is doing well. This year, growth is going to average around 3%. Next year is going to be slightly less than 3%. But I do expect a sharp economic slowdown and the likelihood of a recession by 2020. So for the next 2 years, things are fine, but then we'll have a significant slowdown of growth.
Why? What leads you? I mean, here we are looking at 4.2% economic growth this past week for the final revision for the second quarter. How do you get there for a slowdown and a recession in 2020?
Well, Q1 was 2%, second quarter was 4%, the average is 3%, the third quarter looks like around 3%. So the economy is growing about 3%. CBO and the Fed say potential is around 1.82%. So why did we go from 2% to 3%? Because we had a fiscal stimulus this year and next year of about 1% of GDP. Yes, consumer confidence is better. Yes, business confidence is better. Yes, capex is rising. That increases growth a little bit. But most of the movement from 2 to 3 is essentially fiscal stimulus. Now, the way they design the fiscal stimulus is you have the maximum impact in 2018-19. By 2020, there is, in the data on the legislation, a fiscal cliff. Essentially, the stimulus not only goes away, but you have a beginning of a fiscal drag in 2020, small, only 0.2, and becomes bigger and bigger by 2025. So without the stimulus and its fiscal drag, the 3% pushes you below 2%, around 1.8 by 2020. And then there is other factors. The Fed tightening from 225 to 350. I think they're going to do it because inflation is slightly above target and they have no other choice. You have the trade wars. In my view, we have trade wars, not just trade friction. They're going to slow down growth. There are other policies that are stagflationary on migration, restricting capital flows, foreign direct investment, lack of infrastructure spending, and the rest of the world is weaker.
There are many people who feel that the rollback in regulations was so significant because under the Obama administration, you had, a scenario where businesses were sitting on cash. They didn't know what rule was coming around the corner. This administration rolls back regulation. That's why they believe that there's a long runway in terms of this fiscal stimulus, that it's going to continue to impact corporate America. They're going to increase capex because of the lack of threat of new regulation. You don't buy into that?
Well, I do believe that reducing some regulation might have helped economic growth in the short run. The CBO is estimating officially that tax cuts increases the level of GDP, not even the potential growth, only by 0.1 over a decade. That means 0.01 every year, and then there is a drag after 2020. But there are other types of policies of regulation that slow down growth. In aging population, restricting migration, not just on countries from Arab, but also H-1B visa, slows down the potential growth of the labor supply. We're going to start not just a trade war with China, but with the rest of the world is going to slow down growth and lead to higher inflation. We're going to restrict inward FDI into the U.S. from China and other countries.
Right, foreign direct investment has already slowed down.
Yeah, and we're going to also restrict the ability of firms to invest abroad or produce abroad or hire abroad, right? The whole motto of Trump is hire American, buy American. So you're going to restrict flow of capital, flow of trade, flow of labor. The allocation of labor capital global is going to be worse. That's going to slow down growth, raise inflation. We don't have an infrastructure plan.
You said inflation could be an issue on the horizon, but wages are up 2.9% year over year. We got the PPI and the CPI in the last 2 weeks, and it was non-existent. Where is this inflation that you are identifying?
Well, first of all, wage growth has started to pick up.
Yes.
Towards 3% from 2%. Core PC inflation that last year bottomed out at 1.3%. In the latest numbers, already 1.9, close to the Fed. We have fiscal stimulus that leading to an overheating of the economy. Yes, the Phillips curve is flatter. Yes, there are some structural changes like globalization and trade, but the policies of trade restriction, FDI restriction, migration, and other things are going to slow down potential growth, lead to higher prices, and add gradually towards inflationary pressure. I'm not speaking about high inflation. Inflation is going to go only gradually, based on what the Fed says, slightly above 2.2, 2.3, and the Fed says because of that, and unemployment is below structural, we'll have to gradually raise rates all the way to 3.5% from 2%.
Thank you so much, Nouriel. It's great to see you.